JPMorgan reporting results just a short time ago, and both earnings and revenue were light of expectations. Wilfred Frost joins us now with more trading again. A tough period for a lot of people, I guess, include the first two that have come out. It's reflected in these results.
Certainly the capital markets included within that. The trading has been tough, Joe, you're right. And that theme was through in Citi, and it was also in JPMorgan. The core U.S. consumer, though, is fine, and that theme is in both of these sets of banks' reports. I would say the revenue is actually in line, 26.8 billion as expected. The EPS is a miss, 198 per share. The expectation was 220 per share. But just to focus on that core part of the U.S. business, the lending, the saving, Jamie Dimon in his comments saying the U.S. consumer is spending, saving, investing. They had decent loan growth. Core loans up 6% year over year, up 1% quarter over quarter. That was a little ahead of expectation. We were expecting about 5.1% there. So again, that kind of core part of the business that's really heavily linked to the economy looks okay. Why, therefore, didn't we have a decent EPS beat like Citi did yesterday? That's because Citi's expenses were much better managed than expectations, whereas JPMorgan's have come in 15.7 billion. That is pretty much in line with expectations, perhaps a fraction higher. So the revenue is in line, but the EPS did miss. Now, the trading, as you said, was disappointing. It's somewhat priced in, but was disappointing. On fixed income commodities and currencies, we came in at 1.9 billion, down 18% year over year. Excluding the one-off, Citi was down 21% year over year, but that was well behind forecast. Equity trading was in line, 1.3 billion, essentially flat year over year, maybe up 1% or so when you exclude the one-offs. Investment banking revenue, 1.7 billion. That's just down a little bit year over year and fractionally behind expectations. So yes, that capital market performance, a big challenge for all of these banks, whether you're talking fixed income, certainly, or equities also. And that no doubt will continue to play out throughout the rest of this quarter of earnings, because Citi and JPMorgan are certainly feeling it. Guys?
When you look at the earnings, what do you think that this is going to say about what we're going to be hearing later in the week from the rest of the guys?
Well, it's interesting because I was talking about this with Mike and Sarah on Closing Bell yesterday, which is if all of the banks did what Citi did, which was slightly miss on revenue but beat on EPS, would that be taken as positively as it was yesterday? I think probably you saw a big jump in Citi's and an increase in all of the banks off the back of that yesterday, because people were hoping, okay, Citi's a one-off on the revenue line, but a big beat on the EPS. Hopefully the others can beat on all the lines. And clearly today, JPMorgan showing that that's not the case. And that's why we're now seeing all the banks give up some of those gains from yesterday. On
JPM specifically, I mean, there's some the good points / bad points. One of the things that happened was they grew their reserves because their credit card business actually was growing and improving. That's an interesting issue. And how you decide as an investor effectively to account for that. You also have the private equity business, which had losses in it as well.
Definitely an important one to focus on. Provisions for credit losses, 1.5 billion, an increase of 240 million from the prior year. And yesterday, again, one positive that Citigroup had was that credit costs remained very low. Again, a sign that the economy was fine. So, Andrew, you're absolutely right. We'll have to listen to Jamie Dimon on that point on the call. On the point of Jamie Dimon, interesting, we always listen to his strongly worded views on when he touches on the world of politics. And he did say this. He said, as we head into 2019, we urge our country's leaders to strike a collaborative, constructive tone which would reinforce already strong consumer and business sentiment. So that kind of balance there of decent economy still, but perhaps it could be better still if the politics is more constructive.
Wilf, the stock was almost 120, and in the recent correction, it is down at like 100. So it's already got some stuff in there, I guess. Worries about whatever yield curve, financials, and all that. And then, but on a normal day, I would think if JPMorgan missed the bottom line by 10%, that they might be happy with a 1 3/4%. So who knows where it ends the day? That's not that horrific, whether it's because it's already down from 120 or because, trading, that's not core.
I think to Noah's point, everybody got killed in the fourth quarter.
Right. Well, that's absolutely right, Joe. And you're also right to point out that, last year it's already pulled back a lot, but it outperformed everyone else. It was only down 8% last year.
Real quick, because we want to get to the Delta numbers as well, but is there a bull case to be made for banks given that we had We now have a dovish Fed, right? I don't know what you think, plus the soft capital markets.
Well, I mean, like a lot of these credit measures have rebounded very, very quickly in year to date. I mean, you had like a almost 10% decline, then a 10% rally, and a lot of the credit spreads that blew out tightened back in. So I'm curious what they're going to say about how January's looked or post-Christmas.
Exactly. Have you made up for all of this?
Have you made up for it, or does it come back, or whatever? Because that's what we're going to have to hear what they have to say. But if you're looking at a read on the U.S. economy, look at loans, look at credit cards, look at delinquencies, and it doesn't show an economy going into recession from either Citi or JPMorgan.